Good afternoon, everybody. I think we're going to get started here. Thank you so much for having us. I'm Christine Gagnon. I'm an assurance partner at Eisner Amper. We're a full-service accounting firm with offices all over. So I'm moderating the panel today on the timing and the shift to private credit and some of the stuff going on in the news and the headlines and everything around private credit. It's become quite popular. So I'd like to introduce my panelists today, and instead of me giving you their introductions, if you wouldn't mind just taking a minute or two and introducing yourself and the company that you're with. So I'll start down at the end with Kelly McKenna, and she's a director at Cliffwater. Kelly, do you want to speak a little bit?
Yeah, so I work with Cliffwater. We're an alternative assets advisor and fund manager based out of LA and New York. And I specifically focus on our private credit fund.
Hi, my name's Alex Nolan. I am a principal at Comvest Partners. We are a private investment manager down here in lovely West Palm Beach, Florida. We've been down here for about 25 years, so we're a Florida OG, if you will. We manage $12.5 billion of LP capital on behalf of institutional investors, $2.5 on the buyout private equity side, and 10 on the private credit side. I sit on our originations and sourcing team within private credit, and spent the bulk of my career in financial services oriented credit investing, banking days at JP Morgan, and then a couple of buy-side credit shops before Comvest, and so hence I spend a lot of my time in financial services and asset-based finance, which we'll talk about later. But nice to be here with you guys today.
And I'm Zach Swartz. I'm a partner in the capital markets and M&A practice at Vincent & Elkins, which is a law firm headquartered in Houston. I'm based out of our New York office. I'm just a general corporate attorney. I work primarily with companies in the real estate industry, and my practice kind of spans the entire life cycle of a vehicle that might invest in real estate or really any other kind of corporate. So that it can include private capital raising, hopefully onto sort of a more institutional pre-IPO capital raise and an IPO, and then sort of follow-on offerings after that. Also work with a lot of clients on SEC compliance and corporate governance matters, and work on a number of other sort of corporate transactions as well, public and private M&A, joint ventures, fund formation, and things like that. So it's great to be here.
Great. Thank you guys so much for coming. So as I mentioned earlier, we are going to cover the topic of private credit, which has become extremely popular with investors in recent years. We've seen quite a bit of headlines around it. So I'm going to start with Alex, if that's okay. Let's start off by exploring discussions surrounding recent market volatility and the current elevated interest rate environment that we're dealing with now. So how are private credit firms adapting their underwriting standards and risk management practices to mitigate some of the downside risks around this? And maybe given those same factors, how should business owners think of private credit compared to equity, let's say?
Sure. I'm going to give an answer that a lot of people aren't going to like, and it's that we at Comvest are not changing our underwriting or risk mitigation practices. I think one of the important things that we've lived by over the past, call it 2.5 decades, is discipline, which will be a theme that I talk about more and more as this panel goes on. What I will tell you is that the types of deals that we were competitive on and winning, call it 2-3 years or so ago, we're just not winning anymore. And the reason for that is a lot of capital has been raised around this asset class, as a lot of you all know. There has been a challenged M&A and sort of multiple environment over the past couple of years, which has led to not as many deals needing our capital. But you have all this capital flowing in and not a lot of deals out there. So what do you have? What's the result of that? You have lower price deals than we think make sense. You have looser structures than we think make sense. So a lot of private credit firms are adapting in what we think is a negative way, which is taking on more risk to put capital to work at lower yields. So I will tell you there's two paths I think you can go down as a private credit investor right now. One is sort of participating in that race to the bottom, like I just mentioned, and the other, which I think is what we're doing, is really looking for sort of overlooked asset classes or overlooked industries that are not the private equity darlings, so not business services, not healthcare, right? Things that are a little bit more bespoke. And as an example, we've put a lot of effort and capital behind our asset-based finance strategy, which I spend a lot of time on. We're now over $2 billion deployed in that strategy. And within asset-based finance, we're not just doing consumer loans, credit card, auto. We're doing much more bespoke things that even our direct competitors in ABF, if you will, are not doing. So think lending against, the outcomes of class action lawsuits as an example, lending against catalogs of music royalties, right? Really getting in and figuring out areas that have, complexity premiums to them, so we can get in there and, dictate terms as we, have been used to doing, and really earn sort of, strong risk-adjusted returns for our LPs. So, getting in there and figuring out those areas and staying disciplined is how we've really, sort of differentiated ourselves in this market. And I will tell you sort of, just real quick on debt versus equity, private credit up here, we're not a bank. We're always more expensive than banks. We're typically cheaper than equity. I think we're can provide a lot more flexibility than a bank and can sometimes match the flexibility of equity. But if you're out there thinking about private credit, shameless plug here. Let's connect and talk about it. Would always love to educate you guys about what we can do and sort of the flexibility of our offering. So.
Just to kind of pick up on a couple of things that you mentioned there, Alex, you talked about your LPs. I mean, and Christine, the first part of your question mentioned market volatility. I mean, I think something that's kind of appealing to sort of a prospective, investor in a private credit fund is actually the ability to diversify away from some of that market volatility in the public markets and actually get, exposure to an asset class that might be sort of directly correlated to the varying prices of public stocks and bonds. So I think that's kind of an interesting thing, and that's actually been, certainly my financial advisors keeps calling me, asking me if I want to, sell that S&P 500 index fund with a 0.01 expense ratio and get into private credit. And if you have a long investment horizon, it does make sense. And then you mentioned sort of the choice between debt and equity, kind of there at the end, and to the second part of your question about what business owners might be thinking about. I mean, I think, if you're in a place where you feel like you can get debt on attractive terms and not dilute yourself, right? That's probably a good spot to be in. But really, at the end of the day, it's probably not either or, it's more and both. And I think for our clients, they're constantly evaluating bank financing, private credit, and equity, and if the options are there. And I think a great thing that the private credit asset class has been able to do, particularly in sort of the most recent time, 18 to 24 months, when the equity markets have been really challenging, and banks have which we're going to get into a little bit later here, banks have kind of had to take a step back from some of the more sort of corporate lending, is to be able to step in and fill a gap for companies that are that need capital to stay afloat or grow.
Great, thanks. Kelly, I think I'm going to start with you for the next question, if that's okay.
Yeah.
So what niche or emerging sectors within private credit present the most compelling opportunities for growth, and how do you assess the unique risks associated with these sectors, maybe compared to traditional lending?
Yep, so I will answer that question with a three-letter word, which is ABF. And for those of you who don't know, ABF stands for A Big Friggin' Opportunity. Just kidding. That's your mnemonic for the day. ABF stands for asset-based financing. Alex briefly touched on it already. But taking a step back, so when we talk about traditional direct lending, we're talking about corporate middle market loans to sponsored businesses. They're cash flow based, and they're usually for M&A and LBO financing. That's really been the bread and butter of private credit thus far. Though capital continues to flood this market, you see more and more direct lenders entering the space, you see slower deal flow, and so it's now become a very competitive space to get allocations, and spreads have come down. There's money on the table that is looking for a home, and so I'd say within the kind of still direct lending space, in terms of what are the more niche areas that are becoming more popular, you're starting to see more lending to, for example, non-sponsored borrowers or lower middle market borrowers. But I think where the biggest opportunity is right now is in that asset-based finance space. You see very favorable dynamics. Banks, on the supply and demand side, banks are pulling back, either getting out entirely of that kind of exposure or they're outsourcing it. And then on the investing side, you have institutional investors, your insurance companies, your asset owners, continuing to allocate to private credit, and they need some diversification maybe from the traditional direct lending. Asset-based finance can be a very attractive investment for those portfolios. It's low correlation. You've got backing of the actual assets and the collateral. And from a risk-return perspective, right now you're getting higher return than you might with the traditional direct lending with the same or less risk. So very attractive. And the market's really responding to this need. You're seeing an unprecedented amount of partnerships between whether it's banks partnering with asset-based lenders, insurance companies partnering with asset managers. Everyone wants a piece of this pie right now. Last week, John Gray from Blackstone said in an earnings call he thinks the size of this market is $25 trillion, and that we've really just started to scratch the surface, maybe 1% to 2% penetration from private markets. He did not say how he came up with those numbers, but the point is it's a big opportunity and it's an attractive opportunity. So I'll just briefly touch on the risks. Compared to direct lending, asset-based lending requires it's more labor intensive for sure, and so you're going to want more special expertise in underwriting these loans. They're pretty complicated. And then from a workout perspective, if things go wrong, think for example an infrastructure project, all of a sudden you need to stop the project. That recovery process might be a lot more complicated than, say, a corporate bankruptcy proceeding, and so again, you're going to want to have the right team at the table. There's also valuation risk because for these loans, they're based on an agreement of underlying assets, and the value of those assets might change. But yeah, overall, very exciting area. I think a lot of people are referring to this as the next frontier in private credit. I am not doing a sales plug for Alex, but it turned out to be that way.
I was going to say, you left nothing for me to say, but no, that was a great overview. I think, one of the things that, I'll point out is there are just constantly new and emerging asset classes in ABF. I mean, 2 years ago, nobody was talking about SRTs, like bank SRTs, right, which is synthetic risk transfers, where a bank will have a C&I book and they'll sell insurance on the bottom 15% of that, and that gives them regulatory capital relief. That's now like the trade du jour, right? Like everybody in ABF wants access to that trade. A lot of guys are doing fund finance now as well, including us. We just announced the $450 million deal a few weeks ago, another shameless plug, to a buyout private equity sponsor on a NAV basis. So we're doing a lot in like NAV financing and sort of GP level solutions. So just I don't know if I agree with that $25 trillion number, but there's definitely there's new asset classes every single year that we're learning about, and I think the folks that lean into those new asset classes, and one of the things I was going to say is the people that spend the time figuring those asset classes out are really going to reap the rewards. So I agree. I think it's a great space.
I think this question really is a great example of why private credit might be appealing to sort of any company owner. I think there are certain sectors, particularly emerging sectors, that might have sort of unique financing needs that a traditional bank just might not be able to meet, or might not be able to kind of get their head around as quickly as a private credit fund could. As an example, I recently heard, this was from the American Investment Council, a story about a business that has laundry facilities in college campuses across the country. Great business, lots of cash flow, but in the summer months, right, there's very little cash flow because all the kids are home for the summer. And a traditional bank is going through, looking at the quarterly financials, like wondering what happened to all the cash flow in the summer, right? So like private credit can kind of step in and be like, no, we understand this business, we can help you finance it. I think just at a higher level, right, the folks that work at private credit funds, like the folks on the stage, they can really build specialized knowledge in these emerging asset classes that can allow them to kind of be able to tailor financing solutions, for a company owner in a way that maybe the sort of loan department at a traditional bank might not be able to do.
I loved the $25 trillion number. As an audit partner, I would love to be hired to audit that number, so keep us in mind. So for regulatory stuff, obviously, there's tons of considerations and market trends that I would imagine have allowed private credit to take market share from banks in this space in recent years. Do you anticipate any changes related to the regulations, especially considering any of the recent election results? Zach, do you want to take this one?
We could dedicate an entire day talking about that in the current environment. So I think, I'll just talk about two sort of areas here that come to mind. So one is just obviously regulation of traditional banking, right? So you think about sort of the traditional banking business model. You take short-term liabilities, which are deposits from their customers, turn around and make long-term loans, including corporate loans along the lines of what we're talking about on this panel. And the risk is, right, all the depositors come back and say, I want my money back, and the bank says, oh, sorry, I gave it to that company. It's an illiquid loan, and I don't have your money right now. That sounds familiar. That's Silicon Valley Bank, right? That's exactly what happened to them. And so the modern banking regulatory framework is set up to, address that. And so traditional banks, they have to meet, it depends on the size of the bank, the actual amount and everything like that. But you have to have, a certain amount of capital. You have to meet these liquidity tests. And there's this thing called stress testing, which you probably heard of, right? Where the Fed comes in and looks at a bank's balance sheet and makes judgments about sort of whether or not they're set up to, deal with economic downturns and things like that. In terms of the incoming presidential administration, right, I don't know if anyone paid attention to bank stocks on the day after the election, but they went like that, right? And the reason is because they think there's going to be a fair amount of deregulation of that industry, including sort of the capital and liquidity requirements that I was talking about. So ostensibly, the trickle-down effect is that could make them more competitive in this market that we're talking about. We'll see. There's a lot of details to get worked out about that. I'm not sure Jerome Powell's going to get fired or anything like that, but that was obviously floated. And then the other area I would touch on just real quickly is SEC regulation, right? So obviously, just because there's a financing gap, it doesn't mean that there's readily available capital to fill that gap. But private credit funds have been able to raise billions of dollars of capital from accredited investors in unregistered securities offerings. Including from institutions who, unlike the depositors that fund traditional banks, have long-term capital to offer. So think of like a pension fund, right? And I think this is a trend we've been really seeing playing out in a number of different asset classes, not just private credit, particularly in light of, I think, recent volatility in the public markets and what was a very aggressive SEC in terms of rulemaking and enforcement actions. I think a lot of people looked at what was going on and said, I'm good. I don't think I want to raise capital in the public markets right now. And actually, the accredited investor test is kind of antiquated, if you think about it. I actually saw a statistic the other day that said that as of 2022, 18.5% of U.S. households are accredited investors. And only 21% of U.S. households actually own public securities. So the takeaway there is that the pool of people that are eligible to invest in private funds is roughly the same as the pool of people that actually own public securities. And in terms of what to expect from the incoming presidential administration on this point, they would further expand that, right? I mean, we're talking about, I saw a document that the president-elect has sworn doesn't exist or has no knowledge of that said that just get rid of the accredited investor definition, let anyone invest in private, funds. Or another thing is, in terms of public securities, right? I mean, I think some of the regulation that was adopted during the Biden administration, day one, climate change disclosure, things like that have made it, I think, frankly, less appealing to be a public company in the current environment, probably on the chopping block, right? So yeah, I mean, it'll be interesting to kind of see how it plays out, but I think, deregulation is something that, is in a lot of articles right now, and I think that we would certainly expect that in banking and the securities laws as well.
Yeah, so jumping back to ABF, this is very, very relevant for ABF given that the bulk of that space, you think mortgages, auto loans, credit cards, is all sort of governed by the CFPB, the Consumer Financial Protection Bureau, which was very aggressive during the Biden era. Two asset classes that were particularly active in consumer sort of leasing, as well as debt resolution, debt settlement, saw increased scrutiny. And one of the businesses in debt resolution, thankfully not a business we were invested in, got hit so hard by the CFPB that they ended up going into receivership, and that collateral, those assets that a credit fund that shall not be named lent to, they're now worth zero. So there's definitely consequences and sort of repercussions about investing private credit, specifically ABF, for these regulatory bodies. And I do think with the Trump administration coming in, our expectation is that a lot of that will start to ease. I mean, that's anecdotal. We haven't seen evidence of that yet, but I guess we can comp that to his last term, where the CFPB did sort of take a little bit of a step back and let these industries kind of operate. But as such, and based on what we think is going to happen, we are starting to leg back into consumer finance, albeit very carefully. But we think it'll be a very favorable regulatory environment for investing in consumer assets right now. So.
We're going to move on to technology and innovation. Obviously, this is impacting all of our businesses today. How do you think technology is influencing private credit, particularly in areas like underwriting, like we talked about, risk assessment, any operational efficiencies? Do you think innovations like AI and machine learning are fundamentally reshaping how private credit firms are operating? Kelly, you want to take this one?
Yeah, so I love this question because private credit is really boring, but when you put it in the same sentence with AI and fundamentally reshaping, it sounds really exciting. So I think, a number of things to touch on. Operationally, I think, so I'm going to focus mostly on AI and machine learning. I think, and you're already starting to see this, but obviously these can bring tremendous operational efficiencies. If you think about, you can have a computer doing financial modeling for you, reading stacks of research for you, doing data entry. I think it will free up a lot of time for deal teams to really focus on not the minutia of data entry, et cetera, but digging into the data, whether it's for underwriting or portfolio management. I also don't think it's unreasonable to think that AI can help us achieve better investment performance. If you think about, there's less time spent on mindless things. You're getting more data more quickly, more efficiently, better data. How could that not help your investments? Certainly wouldn't hurt. I think on the fundraising and origination side, to me, that's sort of like partnership work, and I think AI will be very beneficial to any kind of partnership arrangements. It can help generate prospecting, automate emails, come up with deal ideas, et cetera. And then finally, on the investing side, a few thoughts. I think, I don't think that AI will ever displace private credit as we know it. I think private credit is successful because it's so relationship driven. It's very hands-on, it's very flexible, it's very customized. I don't see AI displacing that. Where I do see AI coming in on the investing side, two areas. One is in terms of underwriting or investment decisions. I think we've reached a point where you can no longer think about making an investment, weighing the merits and the risks without thinking about the impact that AI might have on the company or industry you're looking at. No industry is immune from impact, whether it's positive or negative. Just to give an example, some of you may be familiar with the company Chegg, which was a Silicon Valley darling, valued at $15 billion just a few years ago. And basically that company had humans doing what ChatGPT does now, and the stock has fallen 99% in the last 3 years, pretty much entirely because of ChatGPT. So got to think about that in those investments. On the flip side, I would say AI businesses have brought some great deals to the private credit market. Some of the biggest financings that have happened year to date have been to AI businesses. Just as an example, some of you may be familiar with CorpGov. It's an AI infrastructure business that the Wall Street Journal loves to write about. They are based out of New Jersey. They basically make the chips that NVIDIA uses in NVIDIA's AI technology. So this company has done extremely well. They secured one of the largest private debt financings on record this year, $7.5 billion loan. By the way, it was an asset-based loan. But so I think we can thank AI for bringing good deals to the market. And I think, so yeah, big picture, unless you're a bad loan picker, I don't think AI is bad for private credit, but curious your guys' thoughts?
I just have one really quick thing to consider that always pops in my mind. I mean, I do think it's going to lead to more efficient, faster credit decisioning, which if you're not leveraging it, fast forward 5 years, I think you're going to be left behind. So we're definitely leveraging it at Comvest. But one thing that I'm curious others' thoughts on, we can talk about this at the reception maybe, is I do think it's going to supplement or maybe even replace that analyst associate level skill set. I mean, you're not going to need, 22-year-olds cranking on models and memos and building presentations. I don't think we're quite there yet, but I do think that's where it's going. And, so are we going to be training that next generation of people that are going to be able to slot into these seats and really fill that void, or is there going to be a huge knowledge gap? I mean, that's one thing that concerns me. Just an interesting thought I figured I'd throw out there.
Great. Well, thank you guys so much. I wanted to leave a few extra minutes for questions. I'm sure you have some. If we don't get to them all, we can chat after. Anyone have questions? I have one other I can ask if no one else has. Yeah?
My favorite type of audience.
Yeah, right. I guess I'll end with this question then, and if anyone has any others, they can find you in the reception. But Alex, I'll throw this one to you. How resilient do you think private credit is as an asset class against economic downturns? And what lessons have we learned from, all of the recent fluctuations, including, the distress in banks?
I know you've got some great feedback here too, so I'll keep my response short. I mean, I think our thought is it's very resilient so long as you maintain that discipline, right? Like the structure that you can overlay on these deals, like, you don't have to come in and do a cup-light deal or just have a net leverage covenant. Like you can really tailor these deals, especially in ABF, to sort of consider the risks and have resilient structures, right? I think, lessons that we've learned, me personally, I've been in the industry 15 years. I grew up, so to speak, professionally in the zero interest rate policy environment. I didn't know interest rates could go up. So I learned that lesson, and I think the whole industry did. And people that are running these funds that are a lot smarter and more well established and have seen cycles, more cycles than I have, I think when they were underwriting these 2020 to 2023 era deals, like you look at the forward curve and it was relatively flat. So folks were underwriting these deals with no increases in base rates. And when rates started to ratchet up in 23 and 24, then I think a lot of these guys were caught sort of flat-footed, and there's definitely some busted underwriting theses around that, and consequently some problematic credits. So, but all in all, I think it's a resilient asset class as long as you stay disciplined.
Great, thank you. Oh, we have a question. We have a couple minutes.
Speak up. If you're an institutional, it works now. If you're an institutional investor allocating capital to the alternative space, why would you guide them towards private credit versus private equity right now?
Private credit versus
Private equity. Private credit.
We need salespeople on this panel.
I know. We need our fundraising folks on this panel. I don't know. I would say you've got full control. Well, you've got a lot of control over the downside versus, with a PE investment. I mean, EBITDA can sort of evaporate overnight. And, when we're thinking like ABF, right, like you've got real, ABF's a subset of private credit, but there are real pools of underlying, collateral that, you can liquidate, like a performing pool of consumer, mortgages as an example. Like that has value as long as the consumers are making the payment. And if the consumers stop making the payment, you've got the house, right? So there's real, hard collateral behind these versus, a business, a widget manufacturer, there can be a mistake and, EBITDA can vanish, sort of overnight. So that's why I would guide them toward ABF. I mean, on the cash flow lending side, that argument doesn't really hold as much weight, but I think just the predictability of returns and more control over the downside versus private equity. But I'm not a private equity guy, so might not be the answer we want to hear.
I think too, just depend on what they're looking for and what their other exposure might be. Oftentimes you see with private equity correlation with public equity more so than private credit, and what's their risk tolerance. But yeah, the risk return trade-off is very compelling, I think, when you compare the two.
Thank you.